morning, everyone. Welcome back to Finance Friday, another special edition of Money Girl where I answer your burning money questions. Today's topic comes from Bobby, who says, "This year, I cut back on my expenses so I could afford to max out my 401k for the first time. Next year, I'm fortunate to be getting a promotion and salary increase, so I plan to max out the account again. But how should I invest extra money after using my 401k?" Thanks for your question, Bobby. It's a good one. You can use various investment accounts after maxing out a 401k, depending on your finances, tax filing status, and goals. This podcast will review 5 of the best places for your money after you max out a workplace retirement plan, plus terrific options when you don't have a job with a retirement plan. I appreciate you listening. This is episode 890 of the Money Girl podcast. My name is Laura Adams. I'm an award-winning author, financial speaker, money spokesperson, and consumer advocate. Please reach out if you're interested in collaborating for a speaking event or PR campaign. As always, you can reach me using my contact page at lauradadams.com. That's also where you can sign up for my free Substack newsletter called The Money Stack. If you have a money question for the next Finance Friday show, send it to me by email. You can use my contact page at lauradadams.com or leave it on our voicemail by calling 302-364-0308. So Bobby is in a great position. You know, if you are fortunate enough to be able to max out a retirement account at work and still have a little money left over to invest, you're doing great. So if you have a retirement plan offered by an employer, that should be your go-to retirement account. Depending on where you work, the account might be a 401k, 403b, 457, or a TSP, which is a thrift savings plan offered by the government. Now, if you have one, I recommend first investing exclusively in your workplace account because they've got high contribution limits and your employer may contribute additional matching funds as an incentive to participate. But even if you don't get employer matching funds, I still recommend maxing out a workplace plan first. They just come loaded with too many benefits, including tax-deductible contributions for traditional accounts, tax-deferred account earnings, tax-free distributions for Roth accounts, convenient automatic payroll deductions, federal legal protections under the Employee Retirement Income Security Act of 1974, known as ERISA, and free financial advice from your plan's investment brokerage, and super catch-up contribution limits for some older participants that I'll talk about. For 2024, the contribution limit is $23,000 or $30,500 if you're over 50. Now, that's going to increase to $23,500 or $31,000 in 2025. And starting in 2025, those aged 60 to 63 qualify for a higher super catch-up contribution limit of $11,250, giving them a total contribution limit of $34,750. Those high limits and benefits make maxing out a workplace plan your first investing priority a wise money move. All right, so if you're like Bobby and you max out a workplace retirement plan and still have more to invest, I'm going to take you through 5 of the next best accounts to prioritize. Number 1 is a Roth IRA. After maxing out a workplace retirement plan, determine if you qualify for a Roth IRA, which is an excellent place to invest more money. It's available when you have earned income that doesn't exceed an annual limit, which I'll review in a moment. For 2024, you can contribute up to $7,000 or $8,000 if you're over 50 to a Roth IRA. Roth contributions get taxed. However, withdrawals are entirely tax-free in retirement. Because you make taxable contributions, you can withdraw them, but not your earnings, without taxes or penalties. That's why many people use a Roth IRA to save for college or other long-term financial goals. Because a Roth IRA provides so many advantages, it comes with annual income limits that reduce or eliminate contributions for 2024 as follows. If you're a single taxpayer, you must have modified adjusted gross income, or MAGI, of less than $146,000 to contribute the full $7,000 to a Roth IRA. Earning $161,000 or more is the cutoff where you become ineligible for a Roth IRA. Now, married couples filing joint taxes must have MAGI of less than $230,000 to contribute the full $7,000. And for them, earning $240,000 or more makes both of them ineligible for a Roth IRA. Now, for 2025, those Roth income limits will increase. They're going to be increasing for both singles and married people. So single taxpayers must have MAGI of less than $150,000 to contribute the full amount. And when you earn $166,000 or more, that's the cutoff for 2025 where you are ineligible for a Roth IRA as a single. If you're married and you file taxes jointly, you must have MAGI of less than $236,000 to contribute the full $7,000. And when you earn $246,000 or more, that's when you are ineligible for a Roth IRA in 2025 as a married couple filing jointly. Note that unlike a Roth IRA, a Roth retirement account at work, like a Roth 401k, doesn't have any income limits, so you can participate in that plan no matter how much you earn. All right, the second account that you want to think about after maxing out your 401k is a traditional IRA. If you're a high earner, ineligible for a Roth IRA, the next best investing account for you after maximizing a workplace plan will be a traditional IRA because it has no income limits. With traditional accounts, you make pre-tax contributions, giving you an upfront tax deduction in the current year, even if you don't itemize deductions on your tax return. However, when your MAGI falls in some phase-out ranges, your traditional IRA deductions get reduced when you participate in a workplace retirement plan. And when your MAGI exceeds the limit, traditional IRA contributions are allowed but are not deductible. They are non-deductible. So let's go through the traditional IRA deductibility limits for 2024. If you're a single taxpayer, you must have MAGI of $77,000 or less to receive the full $7,000 deduction. Earning $87,000 or more makes you ineligible to deduct traditional IRA contributions when you also participate in a workplace retirement plan. Married couples filing joint taxes must have MAGI of $123,000 or less to receive the full $7,000 deduction. Earning $143,000 or more makes you ineligible to deduct traditional IRA contributions when you also participate in a workplace retirement plan. Like other limits, those are also going up in 2025. So next year, single taxpayers must have MAGI of $79,000 or less to receive the full $7,000 deduction. Earning $89,000 or more makes you ineligible to deduct traditional IRA contributions when you also have a workplace retirement plan in 2025. And married couples filing joint taxes must have a MAGI of $126,000 or less to receive the full $7,000 deduction. For them, earning $146,000 or more makes you ineligible to deduct traditional IRA contributions when you also participate in a workplace retirement plan for 2025. Additionally, if you're not covered by a workplace retirement plan, but your spouse is, there's also a phase-out range for deducting traditional IRA contributions, and that's from $230,000 to $240,000 for 2024. That limit is also increasing to $236,000 to $246,000 for 2025. I know I just threw a ton of numbers at you, but to clarify, you can still contribute to or max out a workplace plan and a traditional IRA in the same year, no matter how much you earn. However, you just may not be able to get the full tax benefit for your traditional IRA contributions. All right, the third account that you should look at after maximizing a workplace plan and perhaps a Roth IRA or traditional IRA is a self-employed retirement account. And I know this won't apply to everyone, but if you do freelance work or you run a business on the side of a job where you participate in a workplace retirement plan, you can also have a self-employed retirement plan. The most popular are the Solo 401k and SEP IRA. Both allow you to contribute much more annually than you can with an IRA or a 401k, but it does depend on your net compensation from your business. For 2024, the maximum contribution for a self-employed plan is $69,000. However, unlike SEP IRAs, solo 401ks allow catch-up contributions, giving those over 50 a maximum contribution of $76,500. And the self-employed retirement contribution limits will increase to $70,000 or $77,500 if you're over 50 in 2025. So you can see all of these limits are increasing a little bit from year to year. And the super catch-up rules apply to solo 401ks, giving those from age 60 to 63 a total limit of $81,250. All right, the next account that you want to think about using after maxing out a retirement plan at work is a health savings account, or HSA. HSAs are one of my favorite accounts. However, they're only available when you have a high-deductible HSA-eligible health plan. If you qualify, the 2024 contribution limit is $4,150 when you have an individual health policy that, just covers yourself. Or if you have a family plan, the limit is $8,300. Now, those limits will increase next year. They're going up to $4,300 and $8,550 in 2025. HSA contributions are tax-deductible, and you can invest them for tax-free growth. Then you can withdraw them to pay or even reimburse yourself for a broad range of eligible healthcare expenses tax-free. So if you have an HSA-eligible health plan, don't miss the really nice benefits you get from an HSA. And lastly, the fifth account that I'm going to recommend you use is a taxable brokerage account. This is the next best place after you've maxed out various tax-advantaged accounts that I've covered here. While it doesn't lower your taxes, it is incredibly flexible because you can tap it for any reason at any time without penalty. And if you want to learn more about taxable investing options, I would encourage you to listen to Money Girl episode 833 called 8 Robo-Platform Benefits Investors Should Know. If you're like Bobby and you max out a workplace retirement plan, that's an excellent accomplishment. That's a really something that not a whole lot of people get to do. But if you do it, don't stop there. Consider investing additional funds in one or more of the accounts I've covered here so you can build as much wealth for your future as possible. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we have a terrific team. Steve Rickyberg audio engineers the show. Brandon Gachis is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.